change in inventory methods, which is a change in the accounting principle. In most cases, when this happens, the company should apply retrospective treatment. In other words, the company should restate their prior year financial statements, including the current year when the new methods applied. So revise prior year financial statements and make adjusting journal entries to the accounts that are affected and disclose the related information in the notes. But if there's a change to LIFO methods, the company don't apply retrospective treatment. Instead, the year when these methods applied, it will become the base year. The inventory was reported in the 2023 year-end balance sheet using average methods. The amount was $123,000. In 2024, the following year, the company decided to change its inventory to FIFO. Therefore, we need to do step 1 to step 3. The value of FIFO inventory was $146,000. The balance of inventory will increase. So we debit the difference, $23,000, to inventory accounts and credit retained earnings. This is the journal entry just for the current year when the methods changed. The company should also restate their prior year financial statements and making journal entries accordingly, and disclose the details in the notes. So here is notes from CVS Health Corporation. In this chapter, you just know the steps. You don't need to know how to restate financial statements. Change to the LIFO methods, as we discussed here, we don't need to apply retrospective treatment. And one of the reasons is when apply LIFO inventory methods or cost flow assumption, it usually is impossible to calculate the income effects on prior years. And we do not report the change retrospectively. And LIFO methods is used from that point on. More disclosures regarding the change of inventory methods. Since the change in the inventory methods we observe from this example, it has impact on both balance sheet and income statements, and finally, it will have impact on retained earnings. So during the year when the change happens, we make adjustment to the beginning balance of retained earnings. In 2024, this company switched to the inventory methods from average cost to FIFO. The ending balance of inventory was $55 million. If the company used FIFO in the same year, the inventory balance would be $50. The $5 million decrease. This $5 million decrease also indicates the cost of goods sold increased $5 million. If we ignore the effect of income tax, this will result in $5 million decrease in the net income and retained earnings. And because reduction in the earnings will equivalent to the reduction in the retained earnings. So this reduction will be adjusted to the beginning balance of 2024 in the account of retained earnings. So we will reduce $5 million to the account's retained earnings.